But what happens if the stock doesn't move? Well, if the stock doesn't move, slowly, day by day, this option that you purchased, if the stock does not move, would slowly erode in value. Why? Well, the reason is that you have the right as a call buyer to purchase the stock at the strike price that you purchased, in this case $27.50, at any time before the third Friday of May. As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. If the probabilities are less that the stock will actually move above $27.50, then obviously that the value of holding that position, that contract, becomes decreasingly less expensive. So, I mean, if you take a look at an option like this over time, let's say that the stock doesn't really move. If over time, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact, that the stock did not go up in price, that you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit. Because they sold it to you at 40 cents, they can buy it back at 10 cents, making a 30-cent profit on that trade. Well, what about the guy who purchased the put option, the option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, the third Friday in May, for our example here, then eventually this option will be worth less and less each week. Let's say next week at this time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only worth 35 cents to 45 cents. Now another week passes by, and it's only 25 cents. See, as long as the stock does not move, these options, all of these options will continue to decline in price if they have extrinsic value. Now the prices of the options, these are called in-the-money options. The in-the-money options have some component of what they call extrinsic value and some component of intrinsic value. And the way you can determine intrinsic and extrinsic value is simply by taking the strike price of the option. In this case, we're taking a look at the May 20 calls, and their price at $7.40. On these 20 calls, if you add the strike price to the price of the call, you get $27.40. At the mid price, you're probably talking about closer to $27.25 or $7.25 for the price of this call option, which is exactly the price of a current stock. So you could say that this call option has no intrinsic value. In fact, if we look under extrinsic value, you can see that it is actually zero. The closer you get to the at the money or the actual price, strike price of the stock, you can see that there is in fact some extrinsic value left. There is some time value left in that option, and that time value is basically saying that, hey, you know what? We do have 3 or 4 weeks before expiration, so the price of the option may actually increase to the point where it might be actually further in the money. What is our objective, though? Okay, this is just, this is just a very brief. You should have already a basic understanding of options. I probably haven't told you anything new. Or maybe I have, I don't know. But depending on your experience. The important thing to remember, though, is that when we trade for monthly income, what we hope to do is not only sell options, we are going to sell both sides. We're going to sell calls and we're going to sell puts. The reason for that is because the stock cannot be in two places at one time. In other words, if you sell this 27.50 and you sell these 25s, well, it can't be both at 25 and 27.50 at expiration. We're going to make money on one side or the other. And that's an important distinction to make because we make money whether the stock goes up or down. Now, the types of vehicles that we use in order to trade options on the exchanges are normally going to be, and I'll go through all those with you in the next series here in portfolio building. What we're going to be using are normally what are called calendar spreads and the sale of vertical spreads, specifically double calendar spreads and the sale of iron condors. Those two strategies will comprise most of our system and most of the trades for the month so that we can make a monthly income and generate a monthly income. Let me just show you the trades that we currently have on so you can kind of get a picture of what I'm talking about. These are trades that we just put on recently. We have 4 positions. We have a iron condor, sale of an iron condor in the diamonds, which is a ETF that mimics the Dow Jones Industrial Average. We have a double calendar rather on the EEM, which is the Emerging Markets ETF. We have a double calendar position on the IWM, which is the Russell 2000 Index, ETF for the Russell 2000 Index. And we have the sale of an iron condor on the SPY, which is a ETF on the S&P 500. These positions, normally when you put them on, all show a loss at the open. However, there's a couple things that you really need to take a look at. Number one, this white line here is what our current profit and loss position is. You can see that the current price, the live price of our portfolio based on the S&P 500, or on the SPY rather, ETF is right here. And in fact, it is in the center between our break-even points. Our break-even point on the low end is down here around 133, and our break-even point on the upper end of the price chart is 143.65, someplace around there. And we are directly, almost in the center of that. Since we just put this position on, we are in a position of a slight loss in our position. However, what we need to take a look at is what happens, as I told you, to a person purchases an option. Now we are selling them that option. We are the seller. And there's 2 rules of the market as far as options go. Number 1, they will fluctuate in price, and number 2, they will always expire. And we take advantage of both of those absolute rules of the option market. And that's what makes this strategy so powerful. Number 1, it fluctuates in price. Well, as you can see, we have lots of room to move. Right now, we're about in the center of this little tent. This is, I explained what this white line is. That's our current profit and loss position. Well, we're currently in a losing position. However, the maximum profit on this position is represented by this green line. The green line is what happens to that option at expiration. And as you can see, if you take a look at this down here in this corner here, if the options were to expire today, we would make a maximum of $1,249 on this position. It's 5/17/08, and we have $1,252 in potential profit in this position at expiration. Today is 4/22, and we have a loss of $79 so far today. If we hold this to expiration, remember what I told you back here, these options slowly will decline in value until they get close to the expiration date, which is the 3rd Friday of May. That's what this green line represents, the 3rd Friday of May. eventually this white line will continue to go up and go up and go up and go up until it meets this green line in which we've achieved our maximum profit. And that's how monthly income is derived from the markets. By selling options to people who want to buy them, who are taking bets basically on a stock, whether it's going to go up or down, and it doesn't matter. To us, it doesn't matter. If the stock goes up or the stock goes down, we make money both ways. Our maximum actual profit position will change depending on the price of the stock itself. So we may have a little bit more profit or maybe have a little bit less profit, but we take advantage of one of the major undeniable rules of options is that they will fluctuate in price. Number two, we take advantage of the second rule of option trading is that all option contracts expire. Once they expire, they either become worthless, or if they have intrinsic value, if they're in the money, they do have some value left to them. We take advantage of those options that are generally out of the money, that have a low probability of actually being worth anything at all, and capturing that so that we can make money. Now, does this work out all of the time? Well, it does and it doesn't. And the reason I say that is because prices do fluctuate. For example, if you put this trade on and then all of a sudden the prices ran up very, very high and all of a sudden they were very close to your break-even point, what would you do? Well, you'd be in a losing position. Also, if you were far from expiration or if you were close to expiration, then you might show a small profit here. And the real key to making the system work is adjustments.